Welcome to The Explainer. Today we are diving deep into a really provocative question, one that's starting to shake the very foundations of the global financial system. It's a story about trust, about paper promises, and yeah, thousands of tons of actual physical metal.
Okay, so let's just get right into it. The whole thing kicks off with a simple question that's also, profoundly destabilizing. Countries like Germany are starting to ask, hey, that physical gold we stored in vaults in the United States for safekeeping, is it actually there? And listen, this isn't some fringe conspiracy theory. It's a question that could literally unravel the way we think about money itself.
And while all that's happening, you see this, an absolutely explosive, just parabolic move in the price of gold. Now, the easy answer is to just say, oh, well, demand is rising. And sure, that's true, but that's only part of the picture. The real driver, the hidden engine behind this crazy chart, might actually be a crisis of supply.
So to really get what's going on, we first have to unpack the demand side of this whole equation. Why is everyone, and I mean everyone, from huge central banks to regular folks, suddenly rushing into gold? Well, this didn't just happen overnight. It's a trend that's been building for more than a decade. Right after the 2008 financial meltdown, central banks quietly started stacking gold. Then, the U.S. fired up the money printers at a rate we've never seen before, and the game completely changed in 2022 when the U.S. seized Russia's assets. That sent a shockwave around the world, basically telling every other country, your dollar reserves are only safe as long as you're on our good side. Now just stop and think about this number for a second. 1/3 of all U.S. dollars that have ever existed were created in just a 2-year window. When you print that much money, you automatically make every single dollar in circulation worth less. It's just simple math. And it naturally pushes people toward hard assets, things you can't just create with a keyboard. And we all felt the result of that, right? In our daily lives. Inflation hit levels we hadn't seen in generations. This wasn't some abstract financial chart anymore. It was the price of gas, the price of groceries, the price of a house. All of a sudden, gold's 5,000-year track record as a stable store of value started looking really, really good.
So, here's the crucial point. All of these reasons for buying gold, the geopolitical fear, the inflation, they're powerful for sure. They're more than enough to explain a big move in the price. But they still don't explain the whole story. There's something else going on just beneath the surface.
To get to the real heart of this, we have to understand this fundamental split. The difference between the gold market that most people see and the actual physical metal that's supposed to back it all up. It's a world of paper promises versus physical reality.
And this right here gets to the core of the tension. On one side, you have physical gold, the real deal. It's rare, you have to dig it out of the ground, and it's been used as money for thousands of years. But on the other side, you have paper gold. These are things like futures contracts, which are really just promises to deliver gold at some point in the future. And this paper market, it's where almost all the trading happens.
Now, these futures markets are actually really useful. They let a mining company, for instance, lock in a price for the gold they plan to dig up next year, which gets rid of a ton of uncertainty for them. But the entire system, the whole shebang, runs on one critical unspoken assumption. And that assumption is that not everyone is going to show up at the same time and demand the real thing. The market only works because most people are happy just trading the paper back and forth. But if that trust breaks down and suddenly a bunch of buyers all say, yeah, I'd like to take physical delivery of my metal now, you get a shortage. It is the exact same dynamic as a classic run on a bank, but for gold.
And when that stress gets really bad, we see this incredibly rare and powerful signal in the market called backwardation. Look, in a normal world, the price of gold for delivery in the future should always be higher than the price today, right? Because you have to pay to store it and insure it. But when that flips, when gold for delivery right now becomes more expensive than gold for delivery later, that is a massive red flag. It means people are so desperate for the physical metal today that they're willing to throw normal financial logic out the window. It's basically the physical supply chain screaming for help.
So how does this all build up into a global issue? Well, all this stress, the crazy demand, the inflation fears, this tension between paper and physical, it all converges on one specific place, a vault, deep underneath the streets of New York City.
You know, everyone always talks about Fort Knox, but Fort Knox is where the U.S. keeps its own gold. The vault that's way more important for this story is the one at the New York Fed. By all accounts, it's the largest single pile of gold anywhere on the planet.
The amount of gold they reportedly have down there is just staggering, over 6,000 metric tons. It's an almost unimaginable pile of wealth. But And this is the detail that changes absolutely everything.
Almost none of it actually belongs to the United States. A jaw-dropping 95% of the gold in that vault is just being held in custody for foreign central banks and international groups. The U.S. is basically just the valet.
So let's put all the clues together. You have skyrocketing demand, a fragile supply chain separating paper promises from physical metal, and the world's biggest stockpile of gold belonging almost entirely to foreign countries that are getting more and more nervous about the US dollar. So, what happens next?
You know, there's a historical precedent for this kind of situation, and it is incredibly sobering. The last time this dynamic played out, the last time major countries started demanding their physical gold back because they'd lost trust in the whole system, the entire global monetary system as they knew it just fell apart. The stakes really couldn't be any higher.
And this breakdown of trust isn't just happening in gold. We're seeing similar pressures in other really important physical assets. Take silver, for example. For years now, production has been falling behind demand, creating this ongoing supply shortage. It all points to a bigger theme. When people lose confidence in paper assets, the scramble for real, tangible stuff begins. We're even seeing investors start to buy mining stocks instead of the metal itself, basically betting that the companies that dig this stuff up will be the biggest winners in a volatile world.
And that brings us to the final, critical question. If those foreign nations, the ones who own 95% of the gold in that New York vault, decide they don't trust the paper promises anymore and actually demand their physical bars back, could that be the run on the bank that finally breaks the entire system? Could this be the catalyst that forces a complete reset of global money? That is the multi-trillion-dollar question, and it's what you should take away from this explainer.